Welcome to Beginner Trading. Tonight's going to be kind of a fun lesson. I'm calling it Don't Get Caught in the Chop, how to approach these choppy charts. So I know most of you have seen kind of like today's stream or kind of witnessed a time where the markets are just kind of choppy. And what we mean by choppy, it's very important. It's kind of what you see is a lot of times short-term traders are getting stopped out of their trades. And the reason being is because long-term traders are kind of piling into the move, and we're getting stopped out in between by using a smaller time frame. So one of the key things in the chop zone is that you really want to start realizing on how you're going to recognize it and what you can do to distinguish it. So how do we recognize the chop, and what's a normal range, and what does a choppy market resemble? In the end, guys, what we want to do to kind of approach these times is we really need to use different time frames to distinguish kind of where the market is or where your stock is. I like to use the 5-minute, 15 or hourly, and of course always the daily. Some of the strongest are always going to be, I think I use the 15-minute more often than the hourly, just because the 15-minute is more along what I trade in between. Most of my trading days consist of 2 hours of trading or an hour and a half of trading. So those are going to be within those 15 minutes and kind of getting those range bound trades. What does different time frames really do for us? Different time frames really give us the ability to see where the stock has kept its range. A lot of times when you're trading, one of the best things you can do is just look at the stock overall. Pull the daily chart up, look to see where the levels are being met, where the resistance is being kind of met, where the support is being held. Look at those volumes. Volume is very, very important here. When you're looking at those daily charts, see where the accumulation's happening and where the follow-throughs are coming. One of the real keys in using the different time frames is you're going to have an ability to really know when the kind of breakouts of the ranges are really happening versus kind of these little fake outs that we get in between the market. We really want to see these breaks of these ranges before we try to make a trade, because when we're kind of range bound and stuck within a consolidation zone, you're going to see that normal chop action where the price level goes up to the resistance, right back down to the support, up to the resistance, right back down to the support. And it can go on and on and on. And what is it really doing is just accumulating volume. But we really need to use those different time frames to understand when do we see these breaks so that we can then approach the trade. I trade the 5 minutes sometimes. One of the real keys, start kind of taking a look more at those charts. And you don't have to really keep them too much in your sights intraday, is start looking to see how they kind of fulfill their own resistance and support. Especially that 15 or hourly, you're going to start seeing kind of those buildups where the levels just kind of meet. And if you look for a smaller time frame within that, you can use that bigger time frame to know the confirmation of where the accumulation is really meeting. It's a great tool to use and a great skill you'll find from many traders to say to use a multi-time frame trade, and this is where they're coming from. So guys, save your capital. There's nothing more important, guys, than saving your capital. In the end of the day, guys, these are going to be the moments where you must learn to be patient and be willing to wait for your wait for your pattern. You know, we're all going to get into the point where you're going to start seeing a lot of trades go through, and you're going to want to make the move. Many traders get stopped out on their short-term trades in between the chop. Reason being is that the long-term traders are adding to their positions as short-term traders panic. This is actually, a lot of times it has to do with more institutional play, or what they call smart money, kind of getting the best of us. We retail traders have a tendency to go after really small percentage moves, and that's why a lot of times you'll hear people talk about going after percentage. And when you trade the chop, a lot of times if you calculated the percentage move, it's not very big. So know the ranges so that you can understand that and not get into that short-term panic that short-term traders get whenever you get this consolidation. This can easily create over trading on a day where you might just be best to call it quits. Marley over here whining a little bit, but I felt the same way today in the market. We can't really whine about the market. Some days it's going to look towards your patterns, and some days it's not. You have to understand that one of the keys of trading is going to know when to save your capital and when to really use it and swing. A lot of traders understand the concept of save your capital, but it's really about that when you use that concept and you save your capital, you're going to have an ability to take swings when you really need it. Especially on slow volume days, you're going to see a lot of times these choppy times come on days where if you look at the daily chart on the SPY or something like that, or on your chart itself, it's not the most volume it's had relative to kind of the average volume. You want to know where the volume is, and if it's just not there, don't try to chase small patterns on a slow volume day just to lose your capital. In the end of the day, we must protect our capital for the trades that actually have the great potential to make you that return. One of the keys is to not just try to catch every fish in the sea. You can't try to be a master of every trade. You can't be trying to catch every trade that happens. If you're seeing kind of the macro of the stock not really follow, you need to understand and save that capital. So what ends up happening to most traders is when we trade the chop zone, we're going to get into what we call overtrading. Overtrading is simply the most common trading error that can drain our accounts. If you'll learn time in and time out that a lot of times when you do kind of blow up your accounts, it's going to be not because you probably traded the worst. There are those traders out there that just aren't following a strategy and really kind of do suck. But what's really going on is a lot of times you're going to find is overtrading. Overtrading at times when they should have just kind of stuck to their strategy, been patient, and waited for the patterns to show up again. The two really kind of key things that you must learn within overtrading, I think, is learning that not every opportunity must be traded. We have to understand that we can't be the magician of all the trades. There's too many trades out there, and as long as you watch the market, you're always going to see an opportunity. But you need to learn that some days there's going to be what we call range bound days. Range bound days are going to be days where the stock is so stuck within a range that your trading is just going to get stopped out and stopped out and stopped out. This is where kind of a lot of, I think, people get the idea that technical analysis doesn't work, is that when you're stuck in a range and you're trading within that range, you can find yourselves in many fake outs. And these fake outs can be very frustrating, as what's really happening is you're not understanding that it's stuck within that range bound. The patient trader knows that every day is not the opportunity. A patient trader knows that every single day that we go into the market, it's not, I'm going to make money every single day. No, that can't be your mentality. Because if you have that mentality, then you want to take a trade every single day. The mentality needs to be is that I'm going to be available for the market. And when I do see a great opportunity, I'm here to take swings, because that's what day traders do. On the second part of overtrading that we talk about tonight is really kind of going back to something that John and I kind of we overlook sometimes, and I even talk to John to sometimes really stay on, is believing in kind of understanding that the macro plays such a big part. I think this is something that even John and I are learning right now, and seeing the macro and the SPY play such a big part in even our penny stocks. The market is ever changing, and with that goes the overall market. Right now we're in times of high volatility, and we've come within a period of consolidation. When you're in high volatility times, you're going to come into kind of these moments where the extension has been met, and now we're in a consolidation, and it should follow with another period of high volatility. And so what we must understand is how the overall market can really affect our stocks, especially those that are moving on no catalyst. We have plenty of stocks right now that are kind of really making moves. And if you look inside, they really don't have a news catalyst out there. There's no new product. They're just moving because the market is moving so much that their stock is a little bit more volatile in their intraday moves. And so within this, it's being traded and being manipulated. And so what we need to understand is, how's the overall market affecting our stocks, especially those that are moving with no catalyst. One of the real keys to trading is learning that tight ranges is all about volume accumulation. And how can we really spot it? And when should we look for the trade is going to be very important. And a lot of traders want to know this third one, is that what really classifies a breakout or breakdown of a stock. Let's take a look a little bit at the kind of the SPY here, and what do we really see here, and why should we use multi-timeframe charts? Here we're looking at a 1 hour chart. Why a 1 hour chart, guys? 1 hour is going to do what? What does 1 hour do that 1 minute can't do? Does anyone know in the chat? Correct, Casey. Casey first to it. It gives direction. It definitely lets us know complete trend. And this is what we're trying to do as traders. We don't want to be fighting the trend. If the stock is going down, we want to go ahead and probably follow that direction. A lot of times when you fight trend, you're going to see a lot of strong reversals, strong squeeze outs, and you're going to lose a lot more money than when you're following the trend. The stock was clearly, you can see it here after Friday, after hours, kind of really got a drive on Friday and got up there. And what happened is we got stuck in the range, guys. We're stuck between this 252 kind of this 152.50 area right here and up here to this 253. And what did we need to see today was actually the SPY break out of that range for us to even understand the direction so that we could take a trade. If we would have been patient enough to understand that that's what we were looking for, and we would have been either patient enough on the short side to see it break down on this side through to, let's say, 251, or to break out through that 253 and then look for long patterns and understand that the overall market is getting that push out of the pattern, out of the consolidation that it's been in for almost a day and a half now. And what do we need to see is we need to see volume accumulation. The volume came in on those big green bars and pushed it up, pushed it back up through the levels. Do you guys kind of see why we should use a bigger time frame to understand and kind of wait to see these breakouts of levels, especially when we see kind of these deep consolidation? Just kind of understand that if the overall market's in consolidation and then your stock doesn't have the right kind of boom, in this case, volume accumulation, you're not going to get that fulfillment of pattern. At least, definitely not going to have the probability on your side because you don't have the volume and the market is kind of working against you as it's itself is building to break out of its range. What's going to be more of a day where you want to attack the market? This is going to be kind of more of a day where you'd want to attack the market. This is on a 5-minute chart. You can see in pre-market, we have like kind of this high right here, which is at 242. Then we have this 240 that's really well defined. It held it, into the close the day before, into after hours. And then pre-market, kind of you see that real tear. And once that tear comes in, you're really looking forward to see what's going to happen at the open. Is it going to hold below that and use it and reject it? And you guys clearly see the opening, goes to that 240, strong rejection, right back down to those important levels of 239 and breaking out of ranges. This is what you want to see. Once you see those breaks of ranges, you're going to have an ability to kind of tackle the stock and understand more where the stock is heading. Once you see those holds and rejections or breakdowns, it just shows you that's movement. That is strength of volume that you can follow. At the end of the day, guys, what we need to do to actually become better traders in these times is really look and overcome the irregular trading. This is what I would call irregular trading. It's the chopped zone. It's learn to have, strict rules on the amount maximum loss per day and week. If you're a kind of trader that you want to have more weekly goals than daily, I understand this. This is what I kind of more abide by. I have a weekly amount and a daily amount, but the daily one is a little subject to change. There's days that I feel I can risk more. There's days that I can risk less. Why? Because there's days that you're going to get bigger range breaks, and those are the days that you want to tackle more size. The days that you're not getting those big range moves, you might have to slow down and kind of hold your trading as you're going to see a lot more fake outs. You need to always have a level where you consider to be over trading. I know John has like 2 trade rule. He very rarely trades over that. I have very similar. I used to trade a lot more, And just realize over time that commissions aren't kind of there to help us, they're there to hurt us. And so you have to understand always strengths and weakness. And one of your strengths that you need to do is not overtrade. That can be a very, very detrimental weakness. You need to learn that where your max amount of trading level should be, kind of 2 to 3 trades. Whether that, you can move up, but you definitely need to have a maximum. That maximum is going to keep you from kind of just stepping into over trading and just blowing through your account. You have to really just set yourself those levels that if you're going to see those broken, and you're not going to trade until you see those levels actually get to those levels. A lot of times we kind of have this mentality pre-market on how we want to trade today. And if you're kind of avoiding that mentality when the market opens, you need to really just stick to kind of your levels. And if your levels are not being met, then kind of just stick to your bones, understand that that's what you need to see to trade. Understand that every day doesn't have to be, a day where you put a trade on. Sometimes the best days are going to be the day where you conserve that capital. Keep your money in your pocket. Know when to spend it. Trade bigger on like the days that you feel you really have that potential versus trading big always, no matter what, just because it's another day in the market and I'm sitting here, I'm going to take a trade. That can't be the mentality. You have to have the mentality that when I do see the right trade, the right setup, that's the one I'm going to take a swing on. That's the one I should conserve. And if I lose on that trade, then that's so it, because those are the trades that I should be taking. Realize that there's better opportunities out there that aren't stuck within the range. You can wait and kind of save your money for another day, and realize that you have to learn to respect our patterns. And if they aren't present, to ignore the noise. If that means turning off, the platform and getting off, getting away from the computer early, going to go do something you love to do, then go do that. What's going to be worse is sitting there through the chop, understanding that your levels are not being met, and all you're doing is just kind of ruining your confidence in your strategy because you're going for these 1 minute patterns that really aren't there. Kind of the last slide of tonight. At the end of the day, guys, there's always going to be changes in the market. You have to let the market come to you. You have to look for your patterns and realize that if it's stuck within a range and it's not your pattern, why are you trading it? You have to know that there's days that you got to swing hard, days that you got to lay low. Yep. Save that capital, save the mental capital, of course. Part that we didn't talk about tonight, but is very important, is understand that we have this kind of emotion that we put into trading. And as a trader, it takes, a lot of energy to pull that emotion out and stick to your strategy. So with that being said, don't waste your energy in trading trades that are not to your strategy and are just going to cause frustration. Stick to your trades that are kind of more mechanical to your systematical approach. And these trades will keep your emotions in check. These trades will let you go ahead and go off the strategy or probability mindset versus that emotional kind of trading where you're just like, am I going to win? Am I going to lose? That's not the way you want to be trading. You want to let the market come to you. You want to take your patterns when you see them, understand the ranges. And if you're not seeing those ranges being broken, then just hang out, go somewhere else, go do something you love, and enjoy your life, Because at the end of the day, if you're going to be a day trader, it's not about one opportunity. It's about understanding there's thousands and thousands. And in your trading career, you're going to be able to make thousands and thousands of big decisions. So some of the best decisions are going to be to wait for that next big opportunity versus taking this small opportunity that most of the time, especially if it's stuck within a range, are just going to get you to start overtrading. So that's pretty much it for the slide basis of tonight.
Hey traders, don't forget to check out our full walkthrough of TradeNet, the pros and cons after years of TradeNet, John's view on how you can go ahead and trade with a great platform for all than less than $400. Definitely check it out. I'll leave the description down below in the link. You can go ahead and check out how we go ahead and use TradeNet.